This is Neil O'Connor, and I'm taking you through International Accounting and Taxation course. And in this textbook, we're using Pereira and Dobnich. We are looking at Chapter 3, International Convergence of Financial Reporting. And here are the learning objectives. We want to explain the meaning of convergence. That's where everything is starting to come together in some way. We want to identify the arguments for and against international convergence of financial reporting standards. We want to explain the principles-based approach used by the IASB in setting accounting standards. Now, the IASB is the International Accounting Standards Board, and we want to describe the proposed changes to the IASB's framework. We want to discuss the IASB standards related to first-time adoption of IFRS and the presentation of financial statements. Now, IFRS stands for the International Financial Reporting Standards, and we want to describe the support for and use of IFRS across countries. We want to examine the issues related to international convergence of financial reporting standards, and we want to describe the progress made with regard to the IASB FASB Convergence project. Now, FASB, Financial Accounting Standards Board of the USA, basically they're the one and only accounting standards board that's governing how accounting should be practiced in the USA, and for the most part they have a lot of differences with the way standards are set or the approach to standard setting that the IASB uses. So let's get into some of these differences and how they're converging over time. So what I've done now is actually provided pages at the top of Chapter 3 for you to follow. And the reason is that there's a lot in Chapter 3 that there's some historical, but there's some more meaningful parts that help you understand the real differences between the International Accounting Standards Board and their approach to standard setting, really the IFRS, and FASB and their approach to standard setting. So the evolution of the IASB and the IASC shows international accounting standard setting in the private sector. It actually tells the story. Basically, there's a lot of convergence happening with the support of accounting bodies, standard setters, capital market regulators, government authorities, and financial statement preparers. I guess the big point here is that there are a lot of stakeholders involved, so convergence cannot happen overnight. But before we talk about the actual history of convergence, harmonization aspects. What do we mean by harmonization? Is it different from convergence? Let's get into the good stuff. Harmonization allows countries to have different standards as long as they do not conflict. It's considered in two ways: harmonization of accounting regulations and standards, or harmonization of accounting practices. So, harmonization is about the reduction of alternatives while maintaining a high degree of flexibility in accounting practices. This is different from convergence. Convergence is about the enforcement of a single set of accepted standards by several regulatory bodies. Now, you can imagine if every company around the world had to use exactly the same accounting standard, that would be perfect for the stakeholders. But you know it's not going to happen. In Chapter 2, we learned because of different cultures, because of different decision makers, different institutional makeups, okay, code law, common law, because of a lot of these different factors, they're really not working towards getting us one converged standard. So what we really talk about now in this chapter is all about the harmonization, about coming closer, but not the enforcement of a single standard. They're two different things. So having said that, we've got all this harmonization going, we've got these challenges, we want to try and come closer together. We know the reasons why we want to do that. Are there other factors? Are there other factors that have worked against, that will work against, have worked against in the past, but will work against in the future towards us having the same standard, having the same practices? And they are as follows. The quality of audits may not be the same in different countries, and partly that goes to the institutional or the regulatory frameworks in different countries that actually regulate the auditors. The PCAOB is a new regulator that's been set up in USA in the last 5 or 6 years to actually monitor the auditors, monitor the monitors. But not every country has a PCAOB. The quality of audits are different. Okay, enforcement mechanisms. The securities commissions in different countries are different. They have different approaches to enforcing particular standards when countries do wrong, do right. The culture is different. As we learned in Chapter 2, some countries are more secretive. Some countries are less transparent. They don't focus so much on disclosure. For example, in Asia, Japan, very specific, and Korea. Contrast that with UK, United States, less secretive and more disclosure. So the culture is impacting on these differences. And also the legal requirements. Legal requirements are impacting on differences, whether you can be sued or can sue, whether you go to court or are fined or imprisoned for actually breaking some accounting law. Socio-economic and political systems. And I mentioned in chapter 2, again, this is kind of a reminder, code law, common law, different approaches, or real specifically different roles of the state in how companies follow accounting standards. So the international convergence of accounting standards refers to both the goal and the process adopted to achieve it. And I guess the big point here is that as much as there are factors that are pulling apart this ideal of doing the same thing together, we still want to try and get some harmonization going. We want to sort of agree on the standard if we can't agree on the practice. So we have a little leeway. So in some countries we can have different practices even though we're trying to follow the same basic standard. That's what we're trying to do with harmonization. So what organizations were involved in harmonization efforts over the last 1 or 2 decades? There was the International Organization of Securities Commissions, International Federation of Accountants, European Union. Actually, the European Union, when they formed over 2 decades ago, basically became a catalyst for having some kind of global international accounting standard. It really started with that because once the European Union formed, then they wanted all the countries to actually do the accounting in the same way. And so this became the catalyst for international accounting over 2 decades ago. The International Forum of Accountancy Development, International Accounting Standards Committee, and probably the most important role or the most important body that's having an impact on things happening today is the International Accounting Standards Board. So what about the International Accounting Standards Committee? It was established in 1973 by leading professional accounting bodies in 10 countries. The broad objective of formulating international accounting standards. They focused on harmonization efforts, and this evolved in 3 main phases. Got male here, but it should be main phases. The lowest common denominator approach, that is, they issued 26 generic international accounting standards, just the basic standards which they felt were the low-hanging fruit and could be applied everywhere very, very quickly. Then they got on to this comparability project, where they published a framework for the preparation and presentation of financial statements. And also they focused on the comparability of financial statements project. And then came the IOSCO agreement. What was really interesting here is that there was a US reaction to the international accounting standards. And we're looking at page 74 here. Before 1996, there was the need and a requirement by the US accounting bodies that if you are listing in USA and you're using an international accounting standard for your balance sheet, for your income, for your cash flow, then you need to have a reconciling statement in the notes to accounts to reconcile with general accepted accounting principles, which is GAAP. In 1996, the US bodies released guidelines for the use of international accounting standards for cross-listing purposes. And at the same year, FASB, that's the Financial Accounting Standards Board, finds differences in 74% of the accounting standards. That means in all the accounting standards in these cross-listed companies, okay, so cross-listed in 2 countries, in all the accounting standards, what they found was 74% of the way in which profits were computed, assets were computed, liabilities, 74% of the standards, the international accounting standards, way of doing something, 74% of these standards were different from the general accepted accounting principles. So the US really had a problem with this because it really lacked comparability. 74%, it wasn't just 14%, it wasn't 24%, it was 74% of the standards were different from the US standards. So there's a bit of a gap there, and this was, 20 years ago. What has happened since in the last 20 years? So the International Accounting Standards Board had some work to do, and so they replaced the International Accounting Standards Committee in 2001, and the IFRS, the International Financial Reporting Standards Foundation. They appointed a board of 16 members, 13 full-time, 3 part-time, and those members, the board, were to approve standards, exposure drafts, and interpretations. And they changed their shift in emphasis from harmonization to global standards setting or convergence. It's really interesting because at the start of this chapter we talked about harmonization, like we want to sort of come together on standards, but we allow different practices. But now they're really moved the emphasis for harmonization to actually global standard setting or convergence, which is a much stricter approach to getting similarity of accounting reporting around the world. The main aim of the International Accounting Standards Board was to develop a set of high-quality financial reporting standards for global use. And here's the structure of the International Accounting Standards Board. There was a monitoring board, there's the IFRS Foundation. The board, as I mentioned, 16 people. There was an IFRS Advisory Council, and there's an Interpretations Committee down below, and then we have various working groups down here. And so there's the different reporting and advisory linkages between the different groups. So we started talking about harmonization, but now we're talking about convergence. Really interesting how the chapter changes shades. So there are various arguments. Convergence, it's a stricter form of bringing more similar practices between the countries around the world. Here are the arguments. To facilitate better comparability of financial statements, easy evaluation of companies. We get that, we understand that. To facilitate international mergers and acquisitions, well, basically it's all about facilitate the due diligence and valuation. To reduce financial reporting costs. We had the example of Daimler-Benz. Over $60 million was spent to actually list in the US stock market. Cross-listing will allow access to less expensive capital. Next, reduce investor uncertainty and the cost of capital. We can see that. And next, reduce the cost of preparing worldwide consolidated financial statements. Obviously, much cheaper if there are less differences, less reconciliations that we have to do. Simplify auditing, we get that. And easily transfer of accounting staff internationally. That makes your job more mobile if you're becoming a professional accountant. So there are various arguments for convergence. We get this, we understand that, we want to come closer together. One more reason for convergence is to raise the quality level of accounting practices internationally. We want to increase the credibility of financial information, and we want to enable developing countries to adopt a ready-made set of high-quality standards with a minimum cost and effort. What about arguments against convergence? Well, it's going to be expensive. There are differences out there, different bodies that want different things. We know that. What is listed here? There are significant differences in accounting standards, in the existing standards. So there's going to be enormous political costs of eliminating these differences. How do you get state law countries, regimes, to agree with code law country regimes? Nationalism and traditions. Arriving at universally accepted principles is very difficult. But as we learn in this unit, IFRS is really principle based. And so we are going down that road of trying to have everyone agree on the various principles of accounting. The need for common standards is not universally accepted. That is, a well-developed global capital market exists already. So if we have a global capital market, then why do we need common standards? The current system is already working. It ain't broke, so why do we need to fix it? That's the point here. Next, it may cause standards overload. Absolutely. The companies, they get listed, they pay all this money. Daimler-Benz is paying $15, $20 million a year just for its accounting. The accountants are loving this. And there are differences in accounting across countries. Might be necessary. They might be necessary because some are linked to taxation, some are not. There are other issues, especially between developed and developing countries. So let's have a look at the principles-based approach to international financial reporting standards. And I think this is a big takeaway from chapter 3. We really haven't looked at this in the last 20 years of saying, okay, let's all agree on the principles of accounting standards, rather than a lot of focus was on let's try and get the same standards in place, even though we may have different practices. But now we've gone back to a principles-based approach with the IFRS. Now, the International Accounting Standards Board follows a principles-based approach to standard setting versus a rules-based approach. What does that mean? Well, standards establish general principles for recognition, measurement, and reporting requirements for transactions. And it limits, at the same time, the principles-based approach limits the guidance and encourages professional judgment in applying general principles to entities or industries. So that means that the revenue recognition principle is the guiding force for determining what is income, what is not income. And so accountants in Europe can say, okay, this is what we see revenue recognition to be, and then they'll apply that. Whereas in the US, they may see the same thing and apply a different practice, but they're both looking at the same principle of revenue recognition. So the IASB Framework, which is really International Accounting Standards Board Framework, the IFRS, was created to develop accounting standards systematically, and this is basically the principles-based framework. And it's a framework for preparation and presentation of financial statements adopted by the IASB in 2001 from the IASC. Scope of the framework: the objective of financial statements and the underlying assumptions, qualitative characteristics that affect the usefulness of financial statements, the definition, recognition, and measurement of financial statements elements, and concepts of capital and capital maintenance. So there are qualitative characteristics of financial statements that we need to think about, and these are issues that are coming into the principles-based framework. Understandability: understandable to people with reasonable financial knowledge. Relevance: useful for making predictions and confirming existing expectations. Affected by nature and materiality of information. So for example, if an economic transaction occurs, then if it only makes up 0.1% of the sales for a particular month, then it may not have as much relevance for an economic transaction with a huge sale that makes 90% of the sales for the month. So therefore, relevance can change depending on the materiality of the event of the transaction. Ultimately, the relevance gets back to what are the decisions being made, and something is relevant is if it affects a future decision and it actually makes you make a different decision when that relevant information comes along. Reliability: this is a very important principle of accounting, and it's all about being neutral, that is without bias, and represents faithfully what it purports to represent again and again and again, year after year, year after year. A side note here: it's reflecting items based on the economic substance rather than their legal form. That's another thing that we're going to come across in this semester. What does substance mean? What does form mean? Substance means the reality of something. Form means we're actually just following various rules. We don't care so much about the reality. Comparability is a final qualitative characteristics of financial statements. Comparability: can we compare one company with another? With minimum adjustments, of course. First time adoptions of IFRS. It provides guidance to companies that are adopting IFRS for the first time. It requires compliance with all effective IFRS at the reporting date of the entity's first IFRS financial statements, but it allows exemptions when the costs outweigh the benefits. So there is very specific guidelines for when companies choose to adopt IFRS, and depending on the country that they're in and depending on what standards they were used previously, they can actually delay or not adopt IFRS. So in a lot of countries, if you're not publicly listed, you don't have to adopt IFRS. And in some countries, they're saying they're encouraging private companies to adopt IFRS. Of course, if you're listed, countries around the world are increasingly saying you now must adopt IFRS if you're listed, but it's optional if you're a private company. International convergence issues. The complicated nature of standards such as financial instruments, fair value accounting, the tax-driven nature of national accounting regime, disagreement with significant IFRS such as financial statements and fair value accounting. There is insufficient guidance on first-time application of IFRS. There are limited capital markets, therefore it's less beneficial. Investor satisfaction with national accounting standards. IFRS difficulties in language transaction. These are all issues that different countries are trying to contend with. And so as you go through to page 92 to 94, have a look at what these issues mean to Hong Kong, to China, and to other countries in the world. The use of IFRS, page 96. Well, there's increasing evidence in the support of IFRS, thankfully, finally. Okay, for example, the original adoption by the European Union. Public companies in the European Union were required to begin using IFRS in 2005. There's IOSCO has endorsed IFRS for cross-listings. So this is basically the International Organization of Security Organizations. You've got the SEC in the US, and you've got other security organizations in different, representing each country around the world. So they're basically endorsed IFRS for cross-listing of companies. So if you're a Hong Kong company, you're a China company, and want to dual list in the USA, now you can use IFRS for your listing in USA. Now, the IFAC G20 Accountancy Summit in July 2009 issued a renewed mandate for the adoption of global accounting standards. Further evidence in support. The latest IFAC Global Leadership Survey emphasised that investors and consumers deserve simpler and more useful information, which is giving support for IFRS. And finally, the adoption of IFRS in 2011. These are the countries that have recently adopted IFRS as their official principles-based accounting standards. Japan, Canada, India, Brazil, and Korea. Now we know China has adopted IFRS in their own way, in the way they practice. It is in their own way. Now, IFRS in the United States, there is a support for principles-based approach, but there's support for it. But what is very important is that they are more concerned about the variance that is a principles-based approach is allowing in how accounting is practiced. You see, a principles-based approach is basically a principle. It's not a standard. It's a way that you should do something, but it's not a definition of you should do it this way, that way only. So you can do it multiple ways to follow a particular principle. And this is why the United States, the FASB, Financial Accounting Standards Board, doesn't necessarily like IFRS. So they support the principles-based approach, but they also say you must follow a particular standard. So the SEC and the IFRS, there's talk about their convergence. It's basically the biggest challenge to international convergence. The United States standard setters, they want a single standard for the different types of accounting that needs to take place in the balance sheet and the income statement. They like the principles-based approach, but they want all countries, all companies represent from different countries using the same standard. And that's not necessarily the requirement of IFRS. That's the problem. Have a look at that from page 98 to 102. So they're trying to converge here. You know it's not going to happen in a short time. The New York Agreement that was in the United States, that was reached in 2002 between the International Accounting Standards Board and the Financial Accounting Standards Board. They pledged for compatible financial reporting standards and proper coordination of work program to maintain compatibility. That is a lot of coordination, a lot more communication between the various accounting standard setting bodies. Now the IASB and the FASB's key initiatives in the New York Agreement: joint projects, short-term convergence, IASB liaison, monitoring IASB projects, convergence research project, and convergence potential. So there's a lot of talk going on here, but at the end of the day, the thing that the FASB doesn't like about the IFRS is that the IFRS is really focusing on a principles-based approach, whereas the FASB prefers that all companies that list in the US follow the same standard, whether it be revenue recognition, asset recognition, liability recognition. They all should follow the same approach to recognizing the different elements of the income statement and the balance sheet. And that is not the first and foremost approach of the IFRS standards. So really interesting in what we are seeing through chapter 3. There's a lot of politics involved. There are a lot of different bodies involved. The other takeaway is harmonization. Understand that harmonization is sort of coming to some agreement about principles, coming to agreement about some standards, but not necessarily enforcing the same practice across different countries. That's what we mean by convergence, and that's the difference between harmonization and convergence. There's been a greater focus on harmonization. Since the global financial crisis, there's been increasing communications about can we do some more convergence, that is, have much more commonality in how accounting is practiced across different countries. So there's a lot of politics involved. There's a lot of things, a lot of bodies out there, like communications going on. At the end of the day, as an international accounting student, you need to appreciate more about what do we mean by the IFRS and what do we mean by the principles-based approach. And we hope to get into that in a bit more detail in the chapters that follow. Catch you in the next chapter. Thank you.